Hello, everyone. Thank you for joining us today. We're very pleased to have Marcelo with us today. Just a quick personal history. I first met Marcelo maybe 6 years ago. I was based in Hong Kong as an investment analyst, and through a mutual friend, I got to know Marcelo. And back then, he was very much in the value camp. He ventured to all the way from Miami to Hong Kong, looking at Asian small caps. So it's been great fun watching him evolve into the current investor he is, and love to learn more from him today. Well, I'll give the stage to Marcelo. He will give us a brief introduction to himself and then also his journey from throughout these years. Thank you.
Yeah, thank you, Dixon. It's very nice to be here, everyone. I'm a big fan of the value investing program at Columbia University. Even though I didn't attend, I've been to a lot of the events. I've met a lot of the students. I met some of the professors, and it's so nice to be able to chat with you and share some thoughts. Like Dixon said, I used to be very much a deep value investor, and I was actually, I think 6 years ago we met because I was in Korea for a trip, and then I went to Hong Kong after that, and I met Dixon, and in Korea also looking at some investments. So I would like to share a presentation that I have prepared for you, and it's just a few slides. I'd like to go through. Dixon proposed this topic from Graham to SaaS investing, and I'll share my screen here, and then we can just open up for questions, because I think that's the more fun part is when you ask questions, and the tougher the better, because I think that's more fun. So I'm sharing the screen here, trying to share with myself inserted, so we can sort of see the slides as well. Okay, so let's just dive right in. Dixon proposed the title. I like to call it value investing in the future, because I still consider myself very much a value investor. So how did this all start for me, right? Like Dixon said, he and I met 6 years ago. Well, around 5 years ago, I started hearing, we all did, right? Disruption here and there. And this was around the time that Google's DeepMind, which is Google's division that does all the incredible artificial intelligence and machine learning work, they started being able to beat video games at expert superhuman levels. And this was kind of shocking, and it sort of blindsided me because I didn't understand machine learning back then. It sounded kind of magical, and I figured that I really had to learn about this, because otherwise I would really be left behind. So started for me a journey of a little bit going back to my roots. I studied engineering at university and was a software developer for 4 years after I graduated from college. And so, and then long story short, ended up getting into very deep value investing, and became a big fan of Graham and Buffett. But this sort of brought me back to my roots, and I said, okay, I have to really start understanding this piece of technology again. So I started studying the history of technology, and what I discovered is that there were all these waves of innovation and creative destruction, as Schumpeter calls it. And so, for example, canals were a mania in this these decades of 1790 to 1810. And then, of course, the railroads came along and totally disrupted the canals and canal investments, by the way. Then we had this wave of gaslighting, which was used for cities around the world. So here's a picture of a gentleman lighting one of these. This is like like the phone booth, right? You still see some phone booths around, but they're just sort of to remind us of what was there. This is kind of the case with this photo. And I like the caption on the photo. It says, "London was a dark city in the 18th century. A brave walker who ventured out without servants to lead the way with a lamp in one hand and a cudgel in the other." So you needed a servant to carry a lamp, and you needed like a club to protect yourself because it was so dark outside. so this was a big innovation at the time, the gas lighting of the streets. And of course, that got disrupted by electric lighting later in the 1880s. And this is probably famous. You've probably seen this before, but I really like it because it's just so shocking when you see how quickly these things happen. So in 1900, this is a photograph of Fifth Avenue in New York City, where a lot of you guys are. And you can just see a bunch of horse-drawn carriages on the top photo, and you can spot in the circle just one car, right? Because this was like a new technology. But then a mere 13 years later, on the bottom photo, this is Fifth Avenue again, and I don't think there's even one horse in the photo. So it happened very, very quickly. And, through my understanding of the history of technology, I started learning that there are these adoption curves that happen. So a new technology gets invented, and it goes from, if you look at the y-axis, 0% adoption for, in this case, households or population. And it follows this S curve to eventually 100% or close to 100% adoption. And so you have here in this chart, the landline, electric power, the automobile, household refrigerator, color TV, and then more recently, you see the internet, you see the cellular phone, and social media. Now, and you can make this chart very busy. There's obviously tons of these adoption curves. What I think is really interesting is you don't really see many macroeconomic events, with the exception, obviously, you have the Great Depression in the early 30s. And then the auto industry suffered not only because of that, but also because most of the car manufacturers in the US were diverted into producing war material in the Second World War. But aside from that, if you inspect these curves and you overlay recessions, for example, you don't really see much going on. And by the way, look at the household refrigerator. That happened during the Great Depression and Second World War, and you don't see a kink on the line. It's just sort of straight up. Now, from an investment perspective, if you look at, for example, Google, there's this adoption curve of online advertising. So a shift from dollars going from offline advertising to online advertising, right? There's a lot of tens of billions of dollars. Google was very young in 2008. So even though we had a big recession, if you look at the financials, Google still grew in 2008, whereas traditional advertising supported media shrank in 2008. And we'll look at why that's the case whenever you have disruptive innovation. The stock price got clobbered temporarily, but it recovered. But sort of the underlying business was still doing very well, which sort of matches the pattern that you see in these adoption curves. So I, did all this study in the history of technology, and then I realized I have two options. I can either just sort of ignore all of this innovation that's happening and not understand disruption and innovation, et cetera. But that to me seemed like a very risky proposition, because if I did that, I would be at risk of investing in things that became a boogie whip manufacturer. So think about the top picture, or maybe I'd be investing in the canals, or maybe I'd be investing in gas lighting, right? Or horses. So the other alternative was I could then adapt and become very, very expert and knowledgeable about cutting edge technology, and really understand how it works, what are the mechanisms there, how to value it, and really become an expert at that frontier. So once I came to this conclusion, it was pretty clear to me that the only option I had was to adapt and survive, and otherwise I would become extinct. And this obviously applies to portfolio management and security selection. Around the same time that I came to this conclusion, I revisited the story of Ben Graham, as everybody knows, the professor who started the sort of value investing program at Columbia University, and his investment in Geico. And I very much on purpose put a very modern picture of Geico here with a smartphone, because the Geico of today had to adapt and is not the same Geico that he invested in 1948. So I rediscovered this story, and it really hit me like a sledgehammer. It was a story that I knew about. I had read about in, many years ago when I read The Intelligent Investor and all the history of value investing. But it was a bit of an outlier story, and I sort of put it aside and said, oh, this is just one thing that he did. But this time it really caught my attention, because I ended up concluding that it was probably the most important thing he ever did. So 1948, let's just revisit the story real quick. Ben Graham actually put 20% of his fund in one stock, Geico. And it was a new business. He considered it sort of a family-owned business. And he just planned on holding it for the long run. And he writes, almost from the start, the quotation appeared much too high in terms of the partner's own investment standards, right? So as soon as he invested, the optical valuation was a little bit excessive for Graham and the partners, but he didn't touch it. So then what happened? He says many years later, the investment obviously produced phenomenal returns, as most of you know. He writes, ironically enough, the aggregate of profits accruing from this single investment decision far exceeded the sum of all the others realized through 20 years of wide-ranging operations in the partner's specialized fields, involving much investigation, endless pondering, and countless individual decisions. So as you know, famously, Graham was involved in doing these arbitrage situations, and he did liquidations, and he was an activist investor. He did all this stuff that involved a lot of work, a lot of hard work and analysis and counting the numbers, etc. But this one stock did better than everything else together. And by the way, there's a very good analysis out there by Irving Kahn that shows that Ben Graham's fund beat the market, but it only beat the market because he had Geico in it. If you take Geico out of the portfolio, he trails the market. So I thought that was very remarkable. The result of this was that in 24 years, the stock Geico went up 145x, which was about 23% compounded. So this really, like I said, I knew about this the first time I read it. I sort of put it aside and thought this is an outlier. But this time I thought, you know what? I think Geico was the only real value in his portfolio, right? That's very valuable to have a powerful investment like that. And I thought, well, why don't I just pack my portfolio with Geico's? Like, wouldn't it be great? Like, what if you could understand the process by which Geico performed this way and harness that understanding to then build a portfolio that is superior in every way? So I put on my venture capitalist hat, which you're like, Marcelo, you have a venture capitalist hat? It turns out that I had also been studying, venture capital and the ecosystem in Silicon Valley. And I realized that there's a lot to learn from venture capitalists, because they have this, they see businesses very early when it's extremely risky. And it's either you survive and you figure out how to survive and grow and gain customers, and you've got to learn how to manage the company. There's all these amazing skill sets that you have to develop, or you're just roadkill. And so the ecosystem in Silicon Valley developed a bunch of tools and relationships to enable that creation of new businesses. And they became really skilled at this, at acquiring customers and measuring the lifetime value of customers, and managing to best practices, and having OKRs, objective and key results, like a bunch of these management innovations come from Silicon Valley. And the reason is because they have to be innovative. Otherwise, it's just a very competitive landscape. So, so I said, okay, well, let me analyze Geico, right? Imagine I'm in 1948 and I'm Ben Graham and I know all this stuff. I know the theory of disruption. I understand technology adoption curves. Could I have underwritten the Geico investment as, let's call it, a venture capitalist? And so what I did is I went back and I looked at data that would have been available to Ben Graham in 1948. And I discovered that you could have looked at car registration data up to 1948. This is the chart of cars and trucks per capita in the US. And I put a little circle there on 1948. So it's about one car for every 4 people in the US. Registrations had been compounding at about 10% per year over the previous 35 years. So it was a growth industry. Then you also had, I found an article in the New York Times from 1947. So this is, remember, right after the Second World War, there was a shortage of steel and there was a lot of pent up demand. You had the baby boomers and, a lot of the soldiers came back and we had this booming economy. So I found an article in the New York Times that said, if you go into a car dealership, good luck finding a car. You got to wait 6, 7 months, maybe a year to get a car. It's just, we can't make them fast enough. So there was a lot of pent up demand. And then lastly, I also realized that a few years earlier, the interstate highway system had been announced. It had not been built yet, but there were plans out there and everything. So imagine now you're trying to underwrite this investment, right? So you know that there's enormous pent up demand for cars. You know that the penetration of cars in the US is still pretty low. And you also know that the number of miles driven is going to explode because there's going to be a massive network of highways in the US that's going to be built over the next couple decades. So you could have underwritten this investment very well based on that alone. But it gets better because, again, understanding Geico with the mindset of a 20th century venture capitalist, you would have noticed that Geico is a disruptive innovator. And this is in the textbook sense of Clay Christensen, which, if you're not familiar with that, I highly recommend you take a look at The Innovator's Dilemma. So this is a business that was direct to consumer, still is, right? Which made it 30% cheaper than competitors or thereabouts, because they didn't have to pay a commission to agents. The other thing is Geico had a superior risk targeting model, right? They targeted, it's in the name, government employees insurance company. So this is pre-FICO score, pre-machine learning, et cetera. You could target customers better by underwriting a lower risk strata of the population. Put together this a lower cost structure and superior risk targeting, you were basically creating a new market in a way. And the market, by the way, was growing very fast, right? As we saw, the automobile market was exploding. So there was a new market being created for the automobile, a new market being created for car insurance. You were accessing new customers because you were targeting a part of the population with direct mail that maybe wasn't targeted before. And you had this aspect of low end disruption because you were less expensive than the alternatives. And finally, you're riding this very powerful technology adoption curve. So those are sort of the key ingredients that I think are very useful for our discussion. Okay, so once we have those ingredients, then let's talk a little bit about valuation. So on the left, I have a picture of one of those TV commercials that Geico has. And very famously, they created this character, the gecko, which is super clever because they don't have to pay actors for the rights anymore. They just made this virtual character famous, right? Incredibly clever. That is CAC, or customer acquisition cost. So Geico spends hundreds of millions of dollars in advertising. The last figure I was actually Googling before this starting this presentation, and I saw Buffett writing in his letters, which I read many years ago, Buffett saying, "Oh, we spend twice as much as our nearest competitor. We have a budget of $800 million, and this is already dated." Why does he spend so much money in advertising? Right? Buffett is the smartest investor in the world, and the reason is he spends so much in advertising because he can do the math, and the math is it costs me X to acquire you as a customer. But once I acquire you, car insurance is an incredibly sticky business. Very few people go around switching their car insurance every month. So and by the way, because they target the risk well, you're going to be a better risk for the company, right? So your lifetime value is going to be very, very high. And that lifetime value relative to the customer acquisition cost, that's sort of the unit economics that we have to think about here. And this is going to be very relevant when we talk about SaaS companies. Now, since Geico was invented and Graham invested in it, the internet obviously came along and changed everything. And I don't think that this is an overstatement. I actually think that this is a very underappreciated point. Why did the internet change everything? It changed everything because it changed the calculus that businesses could make, because it enabled businesses to operate on a whole different level. What does that mean? First of all, you have these zero marginal costs of distribution. Anybody can distribute their product or service if it's internet based, and increasingly things are being digitized. As you know, software is eating the world. You have this zero marginal cost of distribution, and that means that you can very quickly access a global market with billions of customers. Now, what does that entail? What that means is that if you think about customer acquisition costs and lifetime value and all that, you want then to acquire as many customers as possible, as quickly as possible. Why? Because again, the marginal costs of reaching that customer are near zero. So if you don't do it, somebody else will, right? I think I had an extra slide in here that didn't call up, but if you don't do it, somebody else will. That's sort of the point. And so think about Netflix as a good example of this. The people who were short Netflix famously over the last 20 years were saying, well, look at the income statement, look at the free cash flow statement. This doesn't make any sense. Look at the multiple. This is going to crash and burn. The people who were long Netflix understood that they were playing a very different game. They were saying, look, it costs me basically a zero marginal cost, let's say, or close to zero. Obviously, there's bandwidth costs and all that, but serving an incremental customer, if I have 140 million subscribers or 141 million subscribers, it doesn't change my cost that much. If I don't go out and once I grab those subscribers, they're going to be pretty sticky, right? So you have a good lifetime value. Therefore, let me go and grab as many subscribers as I possibly can, as fast as I possibly can. Because if I don't do it, somebody else will. And this is the game that we're playing is a game of land grab. Okay, great. In order for me to be able to acquire as many customers as fast as possible, I need to have the best content. And in order for me to have the best content, I need to spend billions of dollars of content. Does the math work? Oh, yes, it does work. Why? Because if I have a scale advantage, then I can amortize my, what is it now, $15-20 billion of cash content per year, of cash expenses per year for content. I can amortize that over the largest user base of anybody out there. So I'm going to have enormous cost advantages over time. So that was the bet that they made, and it's worked out wonderfully. Now, people complain that the stock market has a short-term mentality. I think it's the exact opposite. Obviously, market discounts things very quickly, but look at how quickly the market figured this out, right? It figured it out so well that Netflix was too expensive optically for a lot of people for this very reason, because markets really understood this game that they were playing. Okay, so let's talk about valuation. It's an extremely important topic, but I think you have to do it differently. I think first you have to understand the unit economics. So the thing that I was talking about in terms of cost of customer acquisition and lifetime value. And this is going to vary among businesses. If you have, like, for example, Netflix has a certain metric for LTV to CAC. If you're talking about enterprise, mission critical enterprise software, it's going to have a much longer potentially lifetime value, but it's also going to have a different customer acquisition cost, and so you have to understand those metrics and different margin structures, right? So that's important. You have to understand what's going to drive the top line revenue growth of the business. Is it going to be seat growth, meaning more subscribers? Is it going to be pricing changes, up or down over time? Will the company be able to layer on additional products and services once it has that customer relationship? And a lot of these things you don't know the answer to, but you have to, this is when, like, you really have to start thinking, like, understanding the DNA of the business, understanding the ambitions of the management team, trying to get a sense of their roadmap and how they think about how big their business could be. You have to go line by line in terms of understanding the cost structure. Okay, start with obviously sales and cost of sales. What is cost of sales? And then once you have that gross margin, sense of gross margins over time, what are your expenses in terms of research and development, which is big. And by the way, I'm sort of, when I'm talking about all this, I'm thinking mostly of obviously tech-enabled companies and technology companies, software companies, however you want to call it. R&D, you have sales and marketing is super important. So that's how much you're going to spend to acquire those customers. What does that look like over time? Does your CAC rise over time? Does it decrease over time? And general administrative expenses as well. That gives you a sense of what free cash flow margins can look like at maturity. And then finally, this is very important. I think multiples are always an output of this process. It's never an input. I think a lot of people make a mistake. They will look at something on a screen and they'll just look at it. Oh, this is a price to sales ratio of X, and therefore, no. I think you have to start the other way around. You're not entitled to use that multiple unless you've done the exercise and done the hard work of really understanding the unit economics of the business and going through all this. And what you'll realize is that those optical multiples are a lot less meaningful than you ever imagined. So this is for me, was a very interesting thing that I discovered recently, is that Amazon used to have this model where they would analyze everything based on a net present value model, but they were then shutting down a lot of potentially very exciting projects. So this framework was recently shared by Andy Jassy. Andy Jassy is the CEO of Amazon Web Services and was a relatively early Amazon employee. And he said, eventually we decided that this NPV model was too constraining because it's very hard to figure out what the potential upside is. And it's very easy to quantify the downside. And again, this goes back to thinking like a venture capitalist. The way, if you listen to a venture capitalist like Marc Andreessen talk, he'll say, look, we should fund as many good ideas as possible because the most we can lose is 1x, the money we put in. But if we don't fund the next Google, Uber, Facebook, whatever, we will lose 1,000x. So meaning we will have foregone 1,000x return on our money. So it's very important to have this upside optionality. And the way you preserve that upside optionality is by not having a rigid mathematical model, because by definition, these things are very fat tails. They can't really fit in your model. By the way, imagine if you were an investor in Amazon. Amazon Web Services was launched, I believe it was March of 2004. Now imagine if you were an investor in Amazon, a shareholder in 2003, and you had to put this on a spreadsheet and you had no knowledge of Amazon Web Services, which went on to revolutionize the world, right? Cloud computing just became a huge thing because of that infrastructure layer that Amazon created. it would have been it would have been impossible. What you should have done instead is really looked at the processes that Amazon used as a business to create innovation inside its business. And this is what Andy Jassy shared with these models. And so he very quickly he said, look, we we focus on these 5 points, and we try to allocate people to them. And I have a blog post that I wrote about this. So just to close up the presentation, we can open up for questions. I've got these guiding principles that I sort of have engraved in my head to try to stay extremely open-minded about all this. One is this idea of strong opinions loosely held. So I think you can't go through life without having strong opinions, but you have to be also very quickly to ditch them if you learn that they're not good opinions. There's this idea that in the beginner's mind there are many possibilities, and in the expert's mind there are few. You don't want to be you don't want to be that guy or gal who has this calcified way of thinking 10 years from now, where you're very dogmatic. I can only buy things with a PE less than 10, because the world changes, and as we saw, a lot of these things don't make sense. There's, by the way, one point that I forgot to make in my previous slide that I'll make now, which is a software as a service company. If you remember that customer acquisition cost arrow down and then the lifetime value arrow up, the more the calculus is, let's take over the world, let's land grab, and then we'll monetize later. The faster a company like that grows, the more it loses money. And so the GAAP financial statements will tell you this is a horrible business. It's losing a ton of money. And oh my God, they just did another equity raise, right? That's horrible. If you understand what they're actually doing, which is we are acquiring customers that have extremely attractive unit economics, which means a high internal rate of return on that customer acquisition cost, you should be cheering on the management team and hoping that they pour kerosene on that fire, meaning speed up the customer acquisition. So it's this big difference between an old school, let's say, way of thinking and the way that you have to adapt in terms of your thinking. This quote by Munger, a lot of you already know that any year that passes in which you don't destroy one of your best loved ideas is a wasted year. It remains day one. It's always day one. Bezos. Perpetual beta is this idea from Super Forecasting, which is a book by Philip Tetlock. It means you're always iterating and trying to improve. And the last thing I want to leave you with is this idea that the world is very complicated and complex. If you don't change your mind all the time, you are just dramatically underestimating how complex things are. So that's the end of my slides. I would love to open it up for Q&A. Thank you.
Thank you so much, Marcelo. Please, everyone, if you have a question, please raise your little blue hand. I think I'll take the first question. Could you maybe share with us a little bit more how you think about normalized margins? Like, how do you estimate where the SG&A will grow, where the operating leverage will come from? How do you do that, especially for a company early on in their life cycle?
So I think there's a few answers. Every time a company goes public, usually they will give you some sense of long-term margins. And it's a pity that these road shows, they show up online or used to be in person, and then they sort of disappear once the company goes public, because there's usually a slide at the end where the CFO will share, this is where our model is right now, we're spending this much on each line item, and this is where we think we could be. That's one way to do it, is to sort of take that as, obviously with a grain of salt, but take that as an input to your thinking about where long-term margins will be. The other way is obviously to reason by analogy and say, well, this is a software company with 86% gross margins, and it's an enterprise software company, and it acquires customers with a hybrid of self onboarding, and also has a high touch sales team. Uh, these are three other companies that kind of look like it, but are much more mature. And these other three companies have 30% free cash flow margins. So it's it's a fair estimate that this company could also produce 30% free cash flow margins at maturity, perhaps even more. So you, and of course, nothing is certain in investing, but you can use these guardrails to try to give you some sense of what this company could produce. But again, I think the exercise of going line by line is very important, especially in absolute dollars. Not saying, you know, this company's going to spend 15% of sales in R&D. Rather, think about how big the top line could be. Is this company going to be doing 1 billion in sales, 5 billion, 10 billion in sales? Why is that feasible, et cetera? But then, does it make sense for me to have a business, you know, of this type? Right now, they're spending 200 million in R&D. Are they going to spend 20 billion in R&D? Or is it going to be 2 billion in R&D? Is it going to be, what number makes sense? How many engineers do they have to hire? So the more granular you can get, I think the better an understanding you have. But you also are at risk of being led astray. So one thing I like to do is always to have not just one model, you have more than one model with different assumptions, because you don't want to be boxed in and sort of, oh yeah, I'm not going to buy this because it has a very low IRR. There's plenty of examples that I can give you where that's happened to me, and then the company just completely blew the lid off and did much better than I expected. So it's an art, not a science.
Okay, open up the floor. We'll have Dean.
Yeah, thank you, Dixon, and thank you, Marcelo. This is actually it's refreshing to hear something a little different from the typical value investing. You know, it's how big can you get? So there's a lot of fun. But Dixon kind of covered it, and you actually somewhat answered it. But it's really tough, the information flow that you're able to get versus as a public investor versus a venture capitalist, for example. So how are you able to be comfortable with, how do you have conviction on some of these upsides? Because, I mean, if we're looking back to early 2000s or whatever, and we're talking about Amazon, most people would have missed on that. So how do you get comfortable with a potential topside or upside scenario?
Yeah, Dean, that's a great point. And I like what you said there. How big could this get? Because as value investors, I think we are all trained to be very pessimistic. Let me protect the downside. If you take care of the downside, the upside will take care of itself. Permanent capital loss. Like, there's all these things that we have ingrained in our heads. If you talk to a venture capitalist, they'll ask the opposite question: what can go right? Right? And like what you said, how big could this get? That's a super tricky question, because a lot of times these are new categories that are being created, and you have to apply just an enormous amount of creative thinking to think about how big this category could be. A lot of times it looks ridiculous. So Airbnb is a new example now. They just filed their S1, and you look at the origin story of Airbnb, and it just sounds utterly insane that strangers would like to stay in other strangers' houses, right? And the way they started with air mattresses in San Francisco. So that's why I think the beginner's mind is so useful, because a lot of times you just have to have this almost childlike approach to things, and just be willing to embrace the unknown. This is obviously from a venture capital perspective. As you get later stage, you have a lot more certainty. And you don't have to necessarily invest in Amazon in 2000, right? You could have waited a little bit, and you still could have made a lot of money. So I think that there's a big spectrum between jumping off a cliff, call it, as like an angel investor, right? Writing a check to a guy that you just had coffee with, and who has that twinkle in his eye, and he's telling you that he's going to change the world. That's one extreme. The other extreme is, let's call it Amazon in 2015, when they finally gave you the financials for AWS. You could have waited. So, and of course, how much do you wait is up to you, and up to how much pattern recognition you could do, how much you're willing to underwrite the future, and how much you're willing to really get deep into the culture and understanding the business. This is a recent journey for me, right? We talked about 6 years ago being in Korea, and Hong Kong, looking at deep value stuff. So I don't know if I could have identified Amazon sooner. But I think that I'm in a better position today to identify things earlier today than I could have ever done before. So I think it's just a constant process of improvement and trying to finesse the way you think about things and revisit your mistakes. And by the way, even the venture capitalists who are in the business of doing this, they have these huge misses all the time, and they just hit their heads against the wall and say, how could I possibly have missed that? But they do it too, because they also work off of pattern recognition.
Thank you. Thank you. And actually, if I could just ask a follow-up, I mean, a lot of us are going to a firm, and we've got PMs. We're not running our own books or anything like that. And you mentioned something that's really top of mind to me. Sometimes it just looks ridiculous. It might be right, but sometimes it just looks a little crazy. So how do you pitch something like that? How do you pitch Amazon back in 2005 or something?
Bill Miller is a value investor who I think he was long Amazon. Was he long Amazon at the IPO? Does anybody know?
Not entirely sure, but I think he held on it for a long time.
He was early, right? He might have been invested at the IPO, if not soon thereafter. So he was a trailblazer in terms of understanding. And I don't recall 100% of his analysis, but I think it was something along the lines of, look, if you understand what they're actually saying, they're saying that they're selling books right now, but books is just the start of it. It's just an early category that they're investing in, and they will eventually be the everything store. And then number two, they had this cash conversion cycle that was super advantageous, because they would get money from the customer 30 days or 60 days or maybe 90 days before they pay their suppliers. So the faster they grew, the better their working capital position, which allowed them to take that money and invest in further growth. So that's something that Bill Miller understood very quickly. And he understood the theory of disruption, which I think is super important if you're investing in this type of stuff, which is, as far as I know, I don't think all the times I went to Omaha and I never heard the words disruption or Clay Christensen disruption, the textbook idea. So I think it's an understudied mental model. And so I don't have a great answer, Dean, but I think with the mental models that I have today, I would have loved to have gone back and done that and see if I could have identified that. Most likely what I would have done is I would have made it a small position. And then, like I like to say, you add wood behind the arrow over time as you see your thesis unfold. So you don't have, and you can, by the way, then you have to average up. You have to buy on the way up. And as you see that the thesis is making sense, you revisit your model, you revisit your assumptions, and you add more wood behind that arrow and make that a bigger position in your portfolio. Or you eliminate it if you're wrong.
Thank you.
Thank you. We have Samir next.
Thanks. Good question, by the way. Interesting to hear you say Airbnb, was a peculiar thesis. I was actually just having a conversation about that on a firm, the PayPal, brainchild, whatever you want to call it. Why would anybody want to pay $130 over time for a product that costs $100? So it's clearly been a huge thing, since it started. So I was wrong on that one for sure. But I guess my question is, this past year, there's been like, I totally agree on the S curve side. And this past year has sort of been that catalyst to get on that vertical side of the S curve for God knows how many industries, digital payments, Zoom, for example, remote working. How do you sort of assess, given that it's such a rapid shift right now, how do you assess which ones have a moat, which ones don't? Do you focus on management? Because personally, like, I see Zoom as something that's replaceable. I think like a large company could take them out. I don't see a network effect. It's a light install. So how do you view like all these new companies that are just shooting to the moon?
Yeah, that's a great question, Samir. The question of moat. Again, I think it's a spectrum, and some of them it's easier to identify than in others. So I agree with you that with Zoom, it's harder to identify. I can very easily make an argument that Zoom is easily disruptible. However, I can also make a somewhat weak argument that they do have obviously they have a lot of customers, they have the biggest mind share, probably the biggest market share if you had a pie chart of video conferences. And unless they make some really bad mistakes, because it's a profitable company, massively profitable company, they can then take those winnings that they won at the casino, let's call it, and invest in really building a platform out of this where you can have an ecosystem built around it. You could have developers, you could have other apps that are built on top of Zoom. You could start building adjacent categories to your video conferencing features, things that will make it extremely sticky: transcription, sentiment analysis, machine learning analysis of meetings, things that I'm saying in this meeting that automatically get added to, let's say, my CRM system, transcription. You could like sort of whiteboard a huge number of things that Zoom could do to make the product way stickier, to make it so that, oh, you know what, I'm going to switch out of Zoom and go to Google Meet, but you know what, I'm not, because Zoom has these incredible features that I like and Google Meet doesn't. So you could think of that snowballing effect where they really reach escape velocity in terms of features that they build. It's a lot easier for me to think about a company like Atlassian or Slack. I don't know if anybody knows what Atlassian is, but Slack, I think, is an easier one. Maybe it's not easy because of the Microsoft threat, but I think that Slack it's building now intercompany network effects with shared channels, so that if I have a Slack instance on my company and I have 100 employees and I have a lot of these custom applications that I've integrated with Slack, now I create a shared channel with your company, Samir, and you have 200 employees, and our employees are in all these shared channels. That makes it super valuable for both of us, and it creates this intercompany network effect where I'm going to start asking my other suppliers, my other business partners, to start using Slack because it makes the conversation much more valuable for both of us. And Atlassian is a different company, but by coincidence, they had an investor day. I think it was yesterday or the day before. It was the day before yesterday. And they shared that if you have an integration in one of their products, I think it might have been Jira, the churn goes down by half. So I thought that was super interesting because it's about friction, right? Once I've built this custom software integration for a tool that I use, and I'm a big enterprise with thousands of employees, it becomes a mission critical piece of software, and I'm not going to churn out of that. And Atlassian is an example of, they share these charts where it just shows the consistency of the business and how sticky it is. They had a line in one of their handouts that said, Atlassian is stickier than roasted marshmallow or melted marshmallow. So it's easier for me to analyze the moat there. And your other question, by the way, was do I look at management? Absolutely. I think this is the epitome of a multi-factor analysis where you have to understand the competitors, you have to understand valuation, sure, the technology, who's buying it, who's using it, et cetera. But also the culture is super important. and by the way, being founder led for me is a super important sort of feature of the investment as well. It's almost a requirement, because it's extremely hard to build a competitive business today in such a fast changing world. And it's almost like if you're not founder led, you're not going to have the sort of moral authority to take the hard decisions and defer gratification and perhaps take a hit to your income statement or your margins on the short term in order to invest for the long term.
Yeah.
As an aside, I just read the book by Bob Iger, The Ride of a Lifetime on Disney, and he's a phenomenal guy, right? If he had been the founder of or the founder of Disney, let's call it, it would have been a different story. But he was a hired professional, and he was subject to the board of directors approval on so many things. And the book, it makes it so clear how hard it was for Bob Iger to do almost anything at the company that he wanted to make these big changes, go into streaming, et cetera, make these big acquisitions, Marvel, without getting the board's approval. Now, and it's just painful to I listened to the book. It's just painful to listen to that story. If you think about a founder-led company, sure, you also have a board of directors that you have to talk to, but a lot of times you might have voting control, or you might have a majority stake or something like that. And even if you don't, you still have that authority of the founder. And it makes it, I think, a lot less difficult, if not a lot easier in some cases, to just say, here's what we have to do, and put a stake on the ground and be very competitive. And I don't think we would be talking about these companies if they weren't founder led, because it's very, very difficult for a hired professional. Not saying it's impossible, but it's very hard for a hired professional to do something like that in such a dynamic and fast changing industry that requires these types of very tough decisions.
So I guess just one quick thing. Sorry, I know there's a bunch of other questions, but you mentioned Atlassian. So Jira, I feel like there's no competition to them right now. And I guess as a person that's, I guess tech investing, growth investing, I know I'm sort of convoluting the two, but, I am not able to, from my perspective, I feel like Jira can be recreated. I could be wrong in that. How do you sort of vet, without like vetting code, obviously, how do you vet, a moat when there's no competition currently existing?
I think it's, in the case of Atlassian, it's not just Jira, but it's like it's a suite of products, right? And they integrate very nicely, and they serve a lot of technical users, but also it's almost half and half now, a lot of non-technical users. And they're trying to create more and more touch points with those users and customers so that it becomes a stickier and stickier product, and they're all nicely integrated with each other. So it's at some point you can be the most well-informed investor on the planet, and you have their source code and you can look at it. At some point you have to say, look, the world is this very complicated, very complex adaptive system. I need to be open-minded to the possibility that I'm wrong on this investment, but I'm going to be very, very, I'm going to monitor these guys very closely. I'm going to talk to management. I'm going to talk to customers, visit the company, look out for competitors. And I think that that's the best you can do, frankly. I don't think you can do better than that in terms of underwriting the competitive risk. And you mentioned, let's go back to Zoom perhaps. If you start seeing a competitor that's got a huge adoption, and maybe it's easier to talk about the iPhone and BlackBerry and Nokia. The iPhone was created, I think it was 2007, and obviously started with nothing, and soon started taking a bigger and bigger share of the market. If you're an investor in Nokia or some other competitive handset, you have to be very, very open to the possibility that you are on the receiving end of that disruption and really understanding the process there. So I think the only thing I can tell you is you have to stay on top of things as much as you possibly can. But I think no amount of due diligence is going to completely eliminate risk or completely eliminate exogenous events, externalities, things like that.
Of course. Cool. Thank you. Appreciate that.
Thank you, Eric.
Hi, Marcelo. Thank you for sharing. Interesting. I have a questions around kind of looking at downside in this investments as well, just thinking about risk as well, because like of the companies we're looking at, most of them are the surviving one, the ones that actually last through 2000s, and 90 out of probably hundreds like actually fail. So, and most of these companies kind of, I think the key difference is that their business model is not necessarily proven yet when I invest. So how do you kind of evaluate that and find out that they're actually investing in the right things? Is it all qualitative, or because like even Netflix at this point, I don't even know the amount of money they're spending on the content is actually the customer lifetime value is actually gonna be bigger than that, because right now the content spending is still larger. They still need a much larger scale. And as they are attacking this local space, there might be competitors who can generate content at a lower cost than they do. Then yeah. So just curious, how do you kind of think about like with an unproven model investing in them? Is it just reflected by your sizing where you're doing a lot smaller sizing in more companies, or how you kind of think about that?
Yeah, Eric, thank you for the question. You bring up a very good point of survivorship bias, right? And that we're looking at we're sort of observing this complex evolutionary system, and we're looking here at the winners, and we're making some conclusions about them, but we're making the wrong conclusions because we're not making if the conclusions that we are deriving from this are not applicable for, let's say, the next cohort of winners. There's a paper by Hendrik Bessembinder. You guys probably read it, called "Do Stocks Outperform Treasury Bills?" And he analyzed U.S. stocks from 1926 through 2016, 90 years, and he found that 96% of stocks did not outperform Treasury bills if held over that period, and only 4% of stocks in the U.S. Generated the entire net wealth. So this points to a very skewed power law distribution, meaning very few companies generated the outsized returns and the vast majority didn't. This is, by the way, also the case if you have a venture capital fund. As you know, a few companies will return multiples of your fund, and the majority will not, will maybe go bankrupt or break even at best. So it turns out that this power law distribution is also true in public markets if you hold these things over the long term. So this is why, by the way, active management is so important. And I'm not even talking about active management of the kind that, for example, we do at Heller House. I'm talking about even the S&P 500 is an active manager, right? They just kicked out a couple companies and added, I think it was a glucose monitoring company and some other. Now this week they added Tesla. I don't know who they kicked out of the index to add Tesla, but they're always doing these rebalancings because even the committee that runs the S&P 500 knows that it has to remain competitive and reflect changes in the economy. So I think that if Netflix is in the too hard pile, then that's fine. You've studied it as much as you can. You're uncertain as to whether the LTV to CAC makes sense, but there's a universe of things out there. You will be able to make inroads with a lot of them. And then I think the job is just to really stay on top of these things and focus and make sure that you are you're understanding the competitive threats as they develop. And you asked the question, is management investing in the right things? You have to really be a business analyst and a strategic thinker and understand business strategy very, very well to be able to evaluate that. So I think that that's a core skill that you need to acquire as an investor is understanding all of those things. Is this company making the right strategic moves? For example, it was pretty clear that that Ballmer was not making the right strategic moves for Microsoft. when he was the CEO, and it's equally clear that that Satya Nadella was making the correct strategic moves for Microsoft when he took over in 2014. So, and I think this is clear even without hindsight bias. So if you look at contemporaneous commentators who understand business strategy for technology companies and understand that company really well, there were a lot of people who had really spot on analyses at the time. So I don't know if, did I answer your question or did I miss some parts of it? I don't know.
No, no, you did. Sorry for the multi-part questions in whole one thing.
Yeah, but I was that somewhat clear? Sorry.
Yeah, pretty clear. I think my takeaway is when something is too hard that you just can't figure out the unit economics or whatever, then maybe that's not a good thing for you to kind of dive into. But for things that we have a clear understanding of the competitive edge and the business strategy, etc., and doing the work can really kind of build our convictions around that. I think that's what you're trying to say, right?
Yeah, I think it's important though not to wave hands too much and say this is too hard, too hard, too hard. I think that that's a cop out to not doing the hard work of understanding things, because by definition, if you are at the cutting edge, it's always going to be too hard. And so you have to always be learning, and you'll have to always be re-examining your assumptions. And maybe you have to go learn to code and to be able to invest in technology companies. So fine. So go learn a new skill. It's very easy to do nowadays. So so I think that that's super important. And if you want to be able to stay competitive as an investor, I think you need to always be enlarging that the frontier of what you're willing to understand. But what I'm saying is, let's say even though you are a master software developer and a master business strategist, you still don't get Netflix's strategy, then yeah, move on. But I think it's important to really put in the work before you make those types of decisions.
Got it. Thank you.
Rodrigo?
Thanks. Hi, Marcelo. Thanks for your time. First of all, I'm curious about when you are making a pitch of a stock, SaaS stock, okay, and you need to give a MOI or a IRR. What is a good exit year? 5 years, or is when the metrics start to go down?
Yeah, Rodrigo, that's a great question, because if you do the math, if you build a model for a lot of these companies, you'll see that. So the way I usually do it is I'll have my assumptions for the top line. I'll have my assumptions for margins. I'll have my assumptions for share count, because these companies have share count dilution over time. They pay their employees in stock. And I'll have net earnings or free cash flow and some conversion between net earnings and free cash flow, how much of it gets converted into free cash flow, how much of that cash accumulates on the balance sheet, if any, and then taxes, etc. So eventually, I believe that everything will trade at some multiple of earnings. So I don't think you can escape the multiple, right? Now, you have to pick an exit multiple. And I'll share with you, there's as you know, there are many editions of security analysis. One of them, and I can't remember what year it was, but I have it on my shelf in my office, was an edition where there was one chapter on growth investing. And it's kind of interesting to see Ben Graham write about that. And he makes a point that this company is growing fast right now. It has a high multiple. In 10 years, it'll probably still be growing pretty fast. Will it have a very low multiple then? He said probably not. It'll still be selling at a high multiple because, it's much more likely that it will. So what's your exit multiple? You have to decide, is it going to be 20 times earnings or 30 times earnings, something like that? I don't know. It's up to you. And then you do your IRR. If you typically what I find in my exercises is that the IRR over the next 4 years is horrible. So if you just look 4 or 5 years, it's not going to be an adequate return. What's very interesting though is that if you hold this over 10 years, and again, you're underwriting a declining revenue growth rate, and you have to have a sense for absolute dollars. Like, does it make sense that this company is going to have 5 billion of revenues or 10 billion in revenues in year 10 or year 12 of my DCF? What I find is that once I get to sort of 10 years out, I have a good sense of my long-term IRR. And this is sort of, again, it's a mix of art and science. It's never a perfect exercise, but I think it gives you some sense of guardrails. Let me put it this way, which I think is a powerful way to think about it, is I cannot prove that something, it's only easy to prove in extremis that something is overvalued. Meaning, at some point, no matter how crazy your assumptions in terms of growth, you will find that there's no adequate IRR to be had. So, but that only happens in extreme scenarios, like if you're in a bubble, something like that. Most of the time, you can change your assumptions with things that you think are reasonable and achieve an internal rate of return that makes sense, especially given where alternative investments are, meaning interest rates, how the index is priced in terms of earnings for the index, et cetera. But it's it's very hard to prove that a company is overvalued, except for those extreme cases. But I think it's very easy to prove that it's undervalued. Meaning, what you can do is you can say, well, let me do my exercise. So you do your exercise, and then you come up and then you say, what is the market pricing in? Wow, the market is pricing in, call it, let's say 10% growth over the next 5 years. That is insane. This company is growing multiples of that, and the market is huge. And I think, and they have all these new product launches, I think it's going to do much more than that. And so even if I dial in a much lower growth rate, my IRR is 20% a year, this is clearly undervalued, right? So I think you can prove to yourself that you have an undervalued situation, like almost like a slam dunk. And by the way, I've had several of those in my models over the last couple of years, where for whatever reason, the fundamentals outpaced the stock price, or there was a temporary decline in the stock price, or things like that. It happens every once in a while. So I don't know if that answers your question, but I tend to want to look further out, because I think if you only look at the next 4 or 5 years, it's very hard to underwrite almost anything that's going to make sense.
Thank you so much.
Elsie, you're next. Thank you.
Thanks for the presentation, Marcelo. My question is more practical. So like you talk about the customer acquisition cost and long-term value. And I feel like for most of the companies, as they grow, the customer acquisition cost will go higher as they move away from their sweet spot and into like more broad mass market. So like, how do you think about that? And like, in addition, it's just hard to get information on customer acquisition costs. And how do you think that the margin and theoretically should decline as you move away from your sweet spot? I'm just wondering, how do you think about those? Thanks.
Yeah, that's a good question, Elsie. So I could say two things. One is, I think in some cases, you're absolutely right. Customer acquisition costs do go up over time because, as you know, there's that famous crossing the chasm framework where you have by the way, the S curve, as you know, is the integral of the normal curve, normal distribution curve. It's sort of like a cumulative chart of that. The normal curve, you can split it into early adopters, early majority, late adopters, and sort of the tail people who will never adopt a product. And crossing the chasm refers to how do I get from those early adopters to the early majority people? How do I cross that chasm? And so, because it's very easy, right, to capture those early adopters. There are some people out there who will try out everything that's new, no matter what. And those might be your most fervent admirers, your biggest fans. But then how do you convince the majority to take over your product? That's true. There's also the other opposite situation where you have sort of increasing returns over time, in the sense that your product has some sort of network effect, or you develop a strong brand over time, and that awareness of your product or that network effect actually lowers your customer acquisition cost over time, because you just become known as the standard for a new category that you defined, or you just become part of the zeitgeist where you become part of culture where everybody sort of knows about you, and it's a lot easier to acquire customers that way. Or you have some sort of very strong network effects, and you almost don't have to spend anything, if you have to spend anything at all, in marketing to acquire new customers. And so I think there's scenarios like that in both scenarios. Facebook, I think, is one example of decreasing acquisition costs over time. In terms of calculating this, the one thing you can do, obviously, and I'm sure you know this, but you can just look at how much the company is spending in sales and marketing every quarter, and how many customers the company acquired through each quarter, and sort of have a rough estimate of the intensity of the spend necessary to acquire that incremental customer. So does that answer your question?
Yes, that's helpful. But in terms of calculation, I feel a lot of the companies, they don't disclose the gross ad versus the churn. So you only have a net ad number, which isn't super helpful.
Yeah, that's true. They almost never give you the gross numbers. And then, you have to have a sense. You have to sort of, maybe you put in your model an estimate of churn. And some companies like Spotify, for example, they gave you a churn number many, many quarters ago, I think when they went public. And then from time to time, they'll say, our churn is down so many basis points this quarter. So you can sort of chain link their comments and figure out roughly what a churn number is today. I will say one thing though. I think it's easy to get caught in the minutia of this, which is fine. But I also think it's important not to miss the big picture, because and not to talk yourself out of something just because you're looking for that extra breadcrumb that you're missing. A lot of times, I always think about the Peter Lynch method of investing, which is, you go to the mall, you see a huge line out the store, and you do some quick evaluation of the company, and you buy the stock because you're like, this is a no-brainer. And it's almost like this Forrest Gump model of investing. I think it's interesting because sometimes that can be very successful as well. For us, we are data driven. We like to be intellectually stimulated and challenged, and we're always going to be seeking out that last piece of information. But and that's fine. We should do that. And I have, if you look at my spreadsheets, I have a ton of data every quarter in all these companies. But also, don't forget the big picture. What do you think about that, by the way, Elsie? Do you think that this makes sense? Or do you think it's critical to have the gross and net number? I mean, ideally, if you're looking at a company, right, it's going to have low churn anyway. So it's going to be like a small differential between that. And by the way, I'll make it one more point that I think is important. Sometimes churn is a feature, not a bug. What do I mean by that? Shopify is a good example, where if you have the same way the internet enabled zero marginal cost of distribution, it also enabled the ability for companies to serve, because again, it costs, how much does it cost Shopify to, like Elsie, you want to start a shop, right, on Shopify. How much does it cost Shopify to provision an extra account on their database for you? Zero, right? So what do? They have a free tier. And so they have a free tier. You can onboard for free. You can start selling immediately and create a shop with a few photos and everything. Now, the flip side is that you're going to have a lot of people onboarding. The flip side is you're going to have a lot of people churning, but that's not a bad thing, because a lot of people churning means a lot of people are trying your product. So what actually matters, obviously, is then the net ads. So maybe we should just be looking at customer acquisition cost and how much in net ads the company is making, or maybe the incremental contribution margin for the customers relative to the customer acquisition cost. Maybe that's another way to think about it, right?
Thank you.
Thank you. We have Robert.
Yeah, thank you. Thank you for being with us today. Very interesting. I was curious whether you had any thoughts on car e-commerce, kind of something that's very, very early in its life cycle. And if you've sort of, I don't know, at least visualized what the future may look like, or could share any perspective. It's an area I find interesting.
Robert, thanks for the question. I'm not terribly familiar with Carvana or its competitors. One thing I'll say is I think from the perspective of Tesla, what I find super interesting is that there was a congressional hearing a couple years ago where Tesla's lawyer, I think, was in front of Congress, and there was also a representative from the automakers, and there was this debate as to whether Tesla should be allowed to sell direct to consumer. And I didn't know this at the time, but what I learned is that the automakers have this these franchise agreement with their dealers, as you know, and it's extremely hard for a car dealership for a car manufacturer to break its contract with a car dealership. So if the future evolves in a way such that cars are sold more direct to consumer without a dealership in between, then those dealerships become liabilities over time. It's also my understanding, again, I'm not an expert in car dealerships, but it's also my understanding that the majority of the margin that they earn is from parts and services, and used cars, and not from selling new cars. So that's also a challenge if cars are going to be sold DTC. By the way, that's also a challenge if cars are sold DTC and cars are much more reliable, which electric cars tend to be, in terms of needing fewer oil changes, none, right? And you're going to have fewer trips to the dealership, and a lot of things that perhaps are fixable remotely through software updates. Those are the only intelligent comments I have on this topic, so I apologize.
No problem. I mean, I know it's not SaaS, but just kind of, I think it fits within the realm of, future bets and visualizing a future that's potentially very different than what we look at today. So thank you. I appreciate it.
Yeah. And by the way, I just want to say one thing is, I think boxing yourself in, not you, but me, like, oh, you are a SaaS investor, or you are a tobacco investor, whatever it is a sure way to sort of not be successful over time. And the reason is, again, I have to be super open-minded about what's going to happen in the future. I think Dixon framed this as a journey from Graham to SaaS to be provocative, but I think it's really a change in the way I started thinking about things. I used to search for things based on valuation. So I used to, for example, scour the London Stock Exchange for closed-end funds trading at a huge discount, and then try to understand what's behind that, and be like, oh, this one owns shopping centers in Germany. Oh, great. And I have a background in real estate investing. So I'm like, great, let me go understand the leases of the shopping center and why, So I inverted that model, where now I try to find the most competitively advantaged businesses with the best management teams and the best tailwinds from these adoption curves. And then I try to understand the business, and then I reach a conclusion on whether valuation makes sense or not. So yeah, could very well be that next month, unlikely, but a few months from now, after I've had time to study the industry, that I'm investing in a digital entrant into car retailing. So yeah, I think it's super important to be open-minded about these things.
Thank you for your perspective. I appreciate it.
Ethan?
Hey, Marcelo, thank you so much for this very instructive dialogue. So my question is actually a little bit related, but more kind of broadly speaking. Given that the path to disruption is often not linear, some companies sort of struggle before they become quote unquote true disruptors. In your opinion, what are some of the companies or perhaps more broadly themes or technology that are kind of flying under the radar right now or perhaps underappreciated by investors at the moment?
Yeah, Ethan, thank you. That's a fun question. I wrote a little piece on my website saying like, the next 10 years or something like that. It's on our blog. And I tried to talk about a few things. They're not under the radar, I don't think. There are more things that I think are sort of almost like no-brainers for the next 10 years. One thing that's a little bit under the radar, and I don't know how it's not under radar for you, I'm sure, but is the whole crypto space, meaning the real life applications of that and real world applications of that and how that's going to change how we do things. And, I need to study the space a lot more in depth, but I think that if a fraction of what the people working on it, if the fraction of what they say turns out to be true, then the world is going to look very, very different in 10 years or 15 years or 20 years, whatever it is, the timeline for the adoption of these things. And I'm talking about things like, as you know, completely changing the way we do payments, completely changing the way we do ownership of digital assets, and being able to monetize things on an infinitely small scale. Like I'm an artist and I have a song and the song lives in some sort of blockchain and I can monetize every time it's played. And it just completely upends the traditional model that we have. As far as things that I think are going to be very impactful, more near term, that I think are a little bit underappreciated, I think the whole augmented reality, virtual reality shift is going to happen probably within the next 10 years. And it'll likely be a new computing platform that's going to complement PCs and mobile. And that's going to be very exciting. And it's hard to forecast how things will change. But I don't know if you've tried the Facebook Oculus Quest, the one without any cords. It is just mind blowing. And so the sense of immersion that you have is incredible. And so when innovation is rarely just one thing, right? It's always a combination of things. You take all these different ingredients and you put them together to create something new. So you're talking about innovations in obviously cloud computing, distributed computing, the ability to have a lot of different people in a digital space together. Like it's very hard to synchronize 20 people, 100 people. I think we can do that now, but like 1,000 people is really hard. Imagine having 1 million people together in a space in a concert in virtual reality. I don't think we can do that yet, but eventually we will be able to. GPT-3 as a linguistic model that allows you to talk to a computer such that it's basically beats the Turing test, right? You can talk to a computer and it sounds like it's a human. What does that do to non-player characters, NPCs in games and virtual reality? How does all that change learning, education? How does all that change entertainment, culture? I think it's going to be revolutionary, but it's very, very hard to forecast. And so I think the best we can all do is just to keep our fingers on the pulse. But if I could point to one thing, it would be the crypto space, because I still think it's kind of nebulous in most people's minds. And I'm not talking about just buying Bitcoin. I'm talking about the whole infrastructure that's being built on and all the protocols and how it's going to change so many things. I think that's underexplored.
Very interesting, certainly quite exciting. And I have not tried the Oculus, but now I have to.
Yeah.
Thank you, Marcelo.
Thank you.
Thank you. And Kostya?
Hi, Marcelo. Thank you again for coming. My question is just that all the examples so far, I don't know if you're just doing it for us because we're a Western audience, but you've mainly talked about US-based companies. So like, how do you look at the developments? Like, I know you worked in Korea and Asia. So like, how are you looking at overseas emerging markets tech companies? So I was just reading AI Superpowers by Kai-Fu Lee, and he was just like talking about all the AI developments in China and like how it's just, they take a completely different heavy asset approach versus the Silicon Valley light touch approach. So if you could just comment on that.
Yeah, that's a great question, Kostya. Thank you. Investing in China is, I think it's its own thing in the sense that you need to have a lot of on the ground knowledge or travel a lot, understand the ecosystem very well. I've been to China once, and I know it's extremely cutthroat. I know it's extremely dynamic. I know it's also problematic from a regulatory perspective, as we just saw with the Ant Financial IPO that got pulled because of criticisms of the government. So it's a tough space, I think, from that perspective, being very dynamic, very different. It's also a little bit of something that I underappreciated until recently is really the whole geopolitical angle of this, where, as you know, the Western companies are blocked in China, right? There's no Facebook, no Twitter, et cetera, because of the control of information there. But we don't do the same to Chinese companies here until, of course, we do. So, right, we had the whole kerfuffle with TikTok earlier this year, and unclear if that's going to continue or not, and what are the implications there. Can you imagine if TikTok or ByteDance were publicly traded in the US, what that would have done to their stock prices, right? So it's, and then there's the angle of propaganda and censorship, where I think if you are, imagine, again, if TikTok is publicly traded in the US, or it doesn't even matter if it's publicly traded, but just imagine TikTok as an investment. And the Chinese Communist Party is then controlling what is seen on the feed, which is a form of censorship and a form of propaganda, because they're allowing you to see other things. And you know, there's speculations that certain rallies that happened before the election were enabled because of groups created in TikTok. And so again, did that have anybody tipping putting their finger on the scale from the government in China? Unknown. So that it's sort of a tricky area to invest in. As far as looking at other emerging markets, I think that, you know, there's no one way to win in this market in the world. I think that there's many roads to Jerusalem, many ways to skin a cat. You know, pick your preferred analogy. So I think that you can develop a huge edge by being a China specialist or by being an emerging market specialist. You know, personally, you know, I focus a lot in the U.S. We have some investments in a few in China. Sort of the things that I can get a better understanding of, a really good understanding of, as much as I can, given all these issues that I just described, and Europe. So yeah, I think it's important to be open-minded about all that, but also to acknowledge some of the risks and the layering of risks. Meaning, let's say that investing in the US and China, you have sort of this baseline of risk, where you have like technological risk, culture risk, et cetera. I think once you start going into other geopolitical environments, you add layers of risk. You maybe add, you know, currency risk is an obvious one. And then you add maybe, you know, intergovernment fighting risk or geopolitical risk. So you start adding layers of risks, and so how do you think about that, and how do you underwrite that? That's an interesting question. So something to think about.
Thank you.
Marcelo, do you have a few more minutes? I have one last question for you. Yeah, so I was just trying to, I was wondering on your position sizing philosophy, how has that changed since you are now 100% invested in SaaS companies, especially since their valuation can jump significantly in a short amount of time? Like since you invested in Shopify, must have become a multi-bagger for you. Did you hold on to it for the whole run, or do you cap it in some ways?
Yep. So that's an important question, and the answer is so far I have not capped it in any way. I have not sold. My inclination is that unless something becomes egregiously, I hate to use the term egregiously overvalued because it's so hard to put a firm marker on what valuation is in terms of, again, modeling the future of the company. For Shopify specifically, Shopify is extremely under monetized, meaning if you look at their different lines of business, one of them, the main one, involves payments. And that one is, hey, we process all these tens of billions of dollars in terms of merchandise that goes through Shopify's customers, merchants. And they use Shopify Pay. And so we get a cut of the payment stream. That's very easy. But the other part is the software that they also sell, all the other subscriptions that they sell and all the other pieces that they can monetize. That is a fraction of 1% in terms of relative to the gross merchandise value. And over time, if you compare this to other online e-commerce sites, which is granted an apples and oranges comparison, but stay with me for a second. Etsy has a take rate in the teens. Amazon is about 20 to 30%. eBay, I believe, is something like 9-10%. So the difference is, I said it's apples and oranges because those have demand generation. They bring you customers, whereas Shopify does not. But eventually there's got to be an increase in take rate as Shopify keeps adding more and more and more value to its merchants and making its product better. They will be able to capture more value as well. Fulfillment is an example, and there's a bunch of other things that they've created on the software side. So again, I'm bringing this all up because if you model different take rates for Shopify over time, you get vastly different results for your model. So even after this run, you can torture your model into something that makes a very interesting IRR. And I use the word torture a little bit facetiously because I don't think that the assumptions are egregious at all in terms of take rate. I think the ceiling of what I modeled is something like 4.85% take rate in terms of ceiling. So is it plausible? Yes. Is it harder than it was obviously at half the current valuation or a third? Sure. So, at that point, what do? Maybe you want to trim the position and invest in something else that's more of a no-brainer, where you're pounding the table and it's obvious to you that it's undervalued. So that's a choice, and that's a constraint because capital is scarce, right? And then you also have to think about, you have to pay taxes when you sell. At least most people do if you're a U.S. investor. The other thing I'll say is, if you, again, I'm referring to that Bessem Binder paper, where you look at these very extreme outcomes from very few companies. It's very likely that if you build a portfolio today and you don't touch it for, let's say you don't touch it for 90 years, just a thought experiment, it's very likely that your returns will be heavily skewed. You're going to have a few companies that are big winners and the majority will not. So do you really want to trim your big winners? So that's one way to think about it. You're never going to get to that leaderboard position on the Bessem Binder paper where the top company generated all this $1 trillion of shareholder wealth. You're never going to get there if you keep trimming your winners. Another way to frame this, by the way, is imagine you're Jeff Bezos, and imagine that you are now you have a net worth now of $20 billion, and you're like, yeah, you know what? I'm a little bit too overweight Amazon stock. I need to diversify. So you sell. He would have never arrived at 120, whatever it is now, $200 billion net worth, because he would have had this mentality of, I need to diversify, the valuation, blah, blah. So it's very interesting to me that as business owners, most of these business owners keep a big stake over time, and end up in these ridiculous situations, ridiculous in a good sense, where they have these amazing stakes in these very valuable companies. Some of them sell over time, sure, and have a lot less left. But I think that if you are riding a rocket ship and the rocket ship is still accelerating in the right direction, the management is on fire, the product market fit is there, where the customers are jumping into your product, you have the ability to hire the best and brightest in the world. Everybody wants to work for your company, right? You have these incredible sort of intangible advantages in terms of talent acquisition and R&D investment, and you perhaps even your CAC is getting lower in terms of acquiring merchants, because now everybody knows about Shopify, and you're getting a lot more people trying your product. I think it would be very foolish to take one factor in isolation, which would be sort of the optical valuation, and use that as a decision-making tool. I think for me, it's much more clear cut. If the fundamentals of the business are not moving in the right direction, that for me is an easy decision where I would like to eliminate the position from the portfolio. But otherwise, I think it's only in an extreme scenario in terms of valuation, or if I have an alternative, something that I'm pounding the table, and because capital is scarce, I need to reallocate.
Okay, fantastic. Thank you so much. It's been wonderful time. Thank you so much for spending nearly 100 minutes with us.
Thank you so much, Dixon, and thanks everybody else. I appreciate it.
Hopefully we'll get you back soon.
Thank you. Have a good day, everyone.
Thank you.
Bye.
Thank you.
Thank you.